Hello, I'm Matthias Gruenwald here. I'm founder of WCG Investments. I'm going to talk about manufacturing housing communities today and how they can provide value to your portfolio.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 537. Manufactured housing doesn't get much attention until markets tighten. That's exactly why my guest today has built a business around it. Matthias Gruenwald is the co-founder of WCG Investments, where he oversees about $45 million across 25 manufactured home communities. Before real estate, Matthias was a global manufacturing COO, and he's brought that same operational discipline into an asset class that rewards execution more than hype. Today, we're talking about manufactured housing as a recession-resilient strategy, what actually creates value at the property level, and why operational excellence matters more here than almost anywhere else in real estate. Matthias, welcome to the show.
Thanks so much for having me. Thanks, Brian.
Tell us a little bit about yourself, how you became a real estate investor, and why manufactured housing.
So like you mentioned in the intro, I was a chief operating officer for a manufacturing company. And I was there for many years, and that's why I moved from Germany to the US back in 2012. And then, around when COVID hit, I think everybody realized, okay, the world is slowing down, and everybody got kind of into themselves and asking themselves questions. I was certainly one of them. And I was like, okay, I'm in an executive position right now, and I'm building a really nice balance sheet for my boss, but not for myself, other than having a well-paid job. But I need to buy some assets and, build some wealth for myself and also generational wealth for my family. And we were planning to, have our first child in the next year or two right after COVID. So we were beginning the conversation. So I was literally put into Google, how do the rich get rich and how you stay wealthy, how you build wealth. And real estate was always on top of the list, at least in the top three. So I did more and more research on it and read a bunch of books, listened to numerous podcasts about real estate. So we started looking into short-term rentals and other asset classes because we love travel and stuff like that. But at that time in 2021, it was super competitive, and I didn't really want to get into like a bidding war with people. And I was like, okay, let me back off from that because, when others are greedy, be fearful. When you're fearful, be greedy. So I was then looking into smaller multifamily because I always liked multi-units, and we looked into a duplex in our market, had some of the contract and backed out of them. And then at some point we bought our first duplex and fell the contract right before Christmas Eve. So we were really aggressive on our offer and got on the contract and bought it, closed on it early 2022. Which was just right about 4 years ago as the time of this recording. And then from there, I just wanted to stack it with buying a fourplex, which I did in 2023, and then go commercial real estate. And then we bought a 26-unit apartment complex, then moved into RV park, 27 units, rather small RV park. And then I met my partner, Tim Woodbridge, through a mastermind, and he was deep into mobile home parks. And I'm still jokingly say today, he showed me the dark side of real estate investing, and I fell in love with the asset class due to numerous reasons with manufactured housing. And then we started, buying our first deal together, which was a 100-unit mobile home park portfolio in Spartanburg, South Carolina, where I was based out of at that time. And we got on the contract early 2024, and it was our first syndication. Had to raise $1.3 million, including the capex. And the rest is history. From there, we bought, up to 25 mobile home communities we have at the moment, and it's about $45 million of assets under management over the last 2.5 years, a little less than 2.5 years actually. So the great partnership that we built together was kind of putting rocket fuel in our growth. We both had what the other one had missing, so that's really sparked a fire in both of us, and core values aligned and everything. And I love the asset class and solving a huge problem in the country with being affordable housing, and we solving that with that niche, certainly.
Ground us in mobile home parks, manufactured housing, and the dark side of real estate investing. When we talk about mobile home parks, are we also talking about manufactured housing? Are the two one and the same?
They're the same, yeah. I mean, it's more These days, they're more manufactured housing communities, the more technical term and the nicer term. You can also call them trailer parks, which if you look at trailer parks, that's, it sounds more condescending, obviously. And those are like your D plus, C minus parks that are out there, neglected in bad areas. And you have the same with apartments. You have D-class apartments. It's the same thing. But all these terms, trailer parks, mobile home parks, manufactured housing communities are all the same thing. These days, are really well-manufactured homes. They have really pristine quality these days. There's different variations how you can buy them and build them. Some are cross mods they're doing these days, where they actually build in a factory, get delivered basically the shell to the side, and everything else is stick built. So it's kind of a mixture of like a mobile home or a manufactured home and a stick build. So that the building quality is phenomenal these days. So they deserve that more sophisticated term of manufactured housing communities, certainly.
How does this help with affordability? You mentioned affordability, and it's very difficult now for people to own their own homes. Why is this one of the solutions?
It's the cheapest way you can live. And we say sometimes we're the last stop for homelessness. I mean, it's the cheapest way to buy a home, rent a home. We have in some of our parks, we have older mobile homes in these parks, and we rent them out for like $700-800 for like a 3-2, for example. You don't get that in apartments. You don't get that in single family, in most markets at least. And even if you buy a brand new mobile home, you get a 3-2 from Clayton Homes for like $45,000. Then you have shipping, permitting, setup, and everything. You may be all in 65, 70. And then we can sell that to the consumers directly, to residents, with numerous different programs that exist out there, which makes it super awesome for the residents too to get their own financing on these homes. And that can be done in markets where the median home is, $250 plus, $300,000 plus. And you could get like a 3-2 for like, $60, $70, $80,000, depending on the size, the location, etc. And of course, you can go wild with mobile homes nowadays. I mean, they make, 5 and 3.5, bedroom mobile homes with a 3,000 square foot. They're like $180,000. You can buy those as well, and they get delivered. We have like an add-on garage that gets stick built next to it. So it's pretty crazy what you can do. But how we solve an affordability crisis, but just being like the cheapest deal in town. It's just imagine you're being a submarine during a hurricane in a storm. You're just like deep in the water, and it's really calm waters underneath the surface, basically. And that's what we're doing. We kind of fly on the radar or swim under the radar, because there's always people, scaling down into our asset class. If they're in like a A class apartment, they can't afford it anymore because they're paying $1,600 a month. They go into a mobile home. Even if you have a brand new one that we have placed in the park, we can rent it out for like $1,000 or $1,100. So it's a major discount for the people, but they have a nice place to live. And these communities these days are really high quality.
You said under the radar. Why is this not more above the radar, where more people are looking to purchase manufactured homes?
It's mainly the stigma, because the trailer parks, some people say, it's just we raise capital for our deals, and sometimes you get the rejection from the investors. They don't want to put their money into trailer parks. So it's just a stigma is a big problem. That stigma is going away slowly, for sure, as you can tell in the industry. If you look deeper and you go to manufactured housing conferences, there's a lot of private equity, there's a lot of money walking around and trying to place capital in these industries. And many big players in the field have done that decades ago already, because they're seeing what's happening in the country of what affordability is concerned, and housing getting more and more expensive. So they're seeing that in advance. So, but the stigma helps to still fly under the radar a little bit, because people just pride themselves with the A-class apartments, the trophy assets they want to invest in and stuff like that. And if you look under the hoods, and if you look at the numbers, you can see how strong these manufactured housing communities are, especially if they are majority tenant-owned homes, meaning we're not responsible for any repair and maintenance on these homes, and we really just get lodge rent or like the lease on the land itself. So it's very low expense ratio, which makes it very recession resistant and also very predictable income, so to speak.
Take us through the numbers. Like how does the manufactured home investment, trailer park, mobile home community investment compare to other commercial type investments? Yeah, the main difference is there's different ways you can buy manufactured housing communities. Some of them are, you have fully tenant-owned homes. Many of them are a mixture. You have tenant and park-owned homes. We call them POH and TOH. And you can convert those POHs, park-owned homes, into TOH, tenant-owned homes. So they have higher expense ratios, of course, with a park-owned home, because kind of like a single-family home, you have to fix them up, you have to pay for repair, maintenance, etc. Many that are dealing with many operators that deal with manufactured housing communities, and they always look for the holy grail, like all the public utilities, all tenant-owned homes, etc. But usually they have a very low cap rate, meaning they're pretty expensive assets.
What we do many times, of course, we buy them as well. We have several parks we bought that all tenant-owned homes, but we buy parks as well. They have a lot of park-owned homes and convert them over time into tenant-owned homes, meaning we either sell them cash, we sell them over a long-term lease with an option to residents over time. We're not holding a note. We just basically saying this is, lease with an option. You can lease it for this amount for this term. And at the end of this term, you can exercise, or during the term, you can exercise your option of purchase. And that actually reduced the expense ratio significantly. So I do own apartments as well. And you have expense ratios in the mid 40s, depending on, the size and stuff. That makes a big difference as well. But it can be in the 50s as well, 50% expense ratio. With mobile home communities, we have some that in like the 31% range because they're all tenant-owned homes, public utilities, etc. So very predictable income. Your majority of your expenses are the management expenses, which is our own in-house management company. We only charge 10% of gross on the gross income, and then really like property tax and insurance, and then you may have some lawn care and maintenance for upkeep for the park itself. And the main reason why we do in-house management on our side as well is because if you just get lot rents in some markets are only $450, $500. If you go with a third-party company, they might charge you 12 to 15% of gross because it's a fraction of the rent they would get with an apartment, but they still have to manage a tenant. So that's why we do our in-house management, and basically the deal wins because we only charge 10%, but we also have another business on the side that makes money as well and can pay our team, so to speak, which manages all the assets. So yeah, from the expense ratio perspective, if we buy a lot of with park-owned homes, we try to get them down to 50. Even we have one park we bought was 70% expense ratio because there were a lot of old mobile homes in these parks, and the previous owner was just fixing them up and turning them. But what we did, we actually sold almost all of these homes to residents directly. Our expense ratio went from 77% when the seller had it down to 38%. So basically cut it in half, but just by that one move, and which is a major value add, which compressed the cap rate because it's a much more attractive asset. It also, increased the value with the cap rate compression significantly. So, yeah, there's a lot more details I can go to. I don't want to bore the audience with all the granular details there, but the majority is like very stable, predictable expenses on these assets because we don't really pay for any surprises, especially if the utilities and infrastructure is all public.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. It really sounds like if you just own the lots and you're leasing the lots, your expense ratio is going to be relatively low. Whereas if you're owning the actual homes as well, you're going to have more upkeep and repairs and maintenance on those homes. So that can boost your expense ratio to what is really an unacceptable level of 77%?
That was one, we bought that was heavily distressed, and we saw the opportunity. It was in a phenomenal market, in a phenomenal location. And that previous owner had 77% expense ratio because he turned all these homes. And I don't think the leasing process was really solid on his end. He placed a lot of bad tenants, and then they trashed the place and he fixed them up again. And then he spent a lot of money on these old mobile homes. And then what we're doing is we call them handyman specials. Instead of pumping a lot of money into them, we just basically put it on Facebook Marketplace, put it on Zillow and say, hey, we have this home. It's a 1995, it has, holes in the floor, it has this and this, needs painting, whatever. You can have it for $100 a month plus lot rent. So you pay $575 a month. You can have it. pay me $100 for 10 years. And people gobble it up like there's no tomorrow. And what it does, we don't pay any repairs anymore. Somebody that comes in that's qualified, they have to put like, what we usually say like a 10% off a potential cash price. Let's say we would sell for 15,000. That would have to give us 1,500 for like a non-refundable option payment or down payment, whatever you want to call it. And from there, I just make those $100 a month for 10 years plus the lot rent. But we pay no repair and maintenance anymore. We don't put any capital in it. And somebody else comes in and fixes up themselves. And they get really cheap housing, right? So they pay $575 and own a home. And imagine people that are contractors or like, or they own their own businesses like HVAC companies, those people, those owners, they gobble those things up. And we have investors coming in, they do this as a side hustle. They have their own business, they have a handyman crew, and they're just going to buy these homes from us, fix them up, and they rent them out for $800-900. But we didn't have to put money in, they do. They can keep the spread. If we get it out for $575 and they fix it up and they rent it out for $800, they can keep the spread, but we didn't have any capital outlay. And the way manufactured housing is valued is based on the lot NOI, the lot rent NOI. Many banks don't even consider the home income, if that makes sense. So as long as we get our lot rent income, and that is as high as possible, and the occupancy is high, that's how we improve the value of the asset. So that's why I love mobile home parks and manufactured housing so much, because you can be so creative with it. And there's so much you can do compared to apartments. You cannot just rip a unit out and just say like, oh yeah, just whatever. We sell just that one unit. I mean, it's a little bit it's like condominiums, right? So that would be quite difficult. That's why I love dealing kind of like with single family homes, like they're single homes, so to speak, but you're converting them into those tenant-owned assets over time, which it's incredible to see the trajectory of an asset when you take it over. It's just chaos in the beginning. And then later it becomes quieter and quieter. And after like 6 months, 8 months, 12 months of ownership, it becomes like you're buying a tenant-owned home asset outright out of the gate, where it becomes very quiet. You don't have to have like weekly meetings with the team. You maybe have like a once a month a check-in and just see what collections are and stuff like that, and then take some small actions if you have to take any. And it's very, very stable. So we buy both, right? We don't buy the distressed assets like all the time. Like sometimes we do, where we try to keep our portfolio very balanced to make sure operationally we can, serve our investors properly and give them the right returns. So we bought a couple of parks that were all tenant-owned homes, and they've been a breeze to manage. So, but they're harder to find because everybody wants them, especially the people that know.
Give us some of your other like value add strategies when you go in and you buy one of these homes. What else do you do to really add value and control expenses and increase income?
Another one is many times you buy a mobile home park and they have an empty spot. Like there's an actual concrete pad, or sometimes even just a dirt pad. Depending on the state, you don't even need, like in South Carolina, where the majority of our portfolio is, you don't even need a concrete pad. It could be just a dirt pad, but there's like a septic tank hookup or whatever, sewer hookup, and the power's right there. So you just bring a new home in, and that, creates, higher occupancy and more income. That's major value add. Then there's different ways how you can sell that home off. You can either sell it cash, and we working with Clayton Homes very directly, and they are working with Vanderbilt, they're affiliated, and they do all the lending on mobile home parks and also on these homes. So you can sell that home either cash to somebody when you advertise it. They get their own financing and basically buy the home off from you, and then you have a straight up tenant on home. Or you can rent it out, or you can do like a long-term lease with an option. Very creative how you can exit out of that one. But that's one value add strategy to get the homes infilled. The second one, like I mentioned earlier, is basically, in short, if you have existing park-owned homes or vacant park-owned homes, even you sell them off, handyman special, long-term lease with an option, or sell them cash. That's a big one. Low-hanging fruit is always under market rents. You don't always find them very easily. But we bought 2 parks last year where we were half of market rents. Where lot rents were like $450, $475, and when we bought it, was very mom and pop operated for decades, meaning 50 plus years, and their lot rents were like $225. Infrastructure was almost non-existent. Like roads were just sand, and it was just sand roads. So were potholes really deep. I mean, if you didn't have a pickup truck, you couldn't go in certain sections of the mobile home park. So we actually went in and paved the road for $100,000, which is a major value increase as well. So that actually compresses the cap rate as well, bringing the value up where you can refi that money out pretty easily over time. So infrastructure repairs are always big. We're converting one park over from a wastewater treatment facility that we have on the property, which it sounds facility. It's not like we have like a wastewater plant on it, but it's mainly like They call them AOSS, an alternate on-site septic system, which is basically like a sewage system that you have on site. You imagine like a mini city, but you're converting that into city sewer and connect to the city sewer line because they're just down the road. So that's a major value add too. That actually also brings expenses down because you don't have to maintain that, wastewater treatment plant anymore. So that's a major value add too. So yeah, those are the major ones. And there's also some little intricate little things you can do as well. But those are the main value adds on manufactured housing communities.
What are some risks and pitfalls that you really need to do your due diligence on before you go in and buy?
So definitely on infrastructure, make sure that you know what you're getting yourself into. I just mentioned the sewer situation. So many times mobile home parks have a like sewage pond or like lagoon, they call them, which is basically just like, a pond with feces in it, basically. And that can get you in trouble if you don't maintain it well. I know some people, they are operators in that field, and they just buy that because that's a very small buyer pool that wants to deal with these things. And you can make some good money with it, but you're also shrinking the pool of other buyers if you want to ever exit from it. So you should stay away from them. You can do it. I'm not telling the audience not to do it. I'm just saying you have to be very careful what you get yourself into. If you don't do proper due diligence, you can actually inherit a huge issue. And repairing those things can be extremely expensive.
Why would some buyers find that attractive? Like, why are there buyers who look for communities that have a feces pond?
It's just like choosing your heart, right? It's like we buy a lot of parks that have park-on homes. Some don't touch them. That's the heart we are choosing. That's the hard part about bringing a value add, right? Or doing a value add. So some people don't touch them. We chose that as our, let's touch them, and we know how to convert them, which is a lot of work for like 6 to 12 months. Also, depending on the size of the deal, but it's doable. And the same with that person that I know, he gets into them because he's really good at it. He knows exactly what to do. It's in its market. He's in the Midwest. There's a lot of lagoons out there and with these mobile home parks, and he buys some really highly under market rent parks as well, and he does well. So why wouldn't he do it? So it works for him. I think if we would come in from out of state and try to do the same thing in his market, we probably would fail because first of all, we have no experience with lagoons. We have no experience with the market. He has all the connections on site. He knows people that can actually service them. He's really good at them. He knows what a good one looks like and what a bad one looks like. He knows what to look for. Of course, you can always outsource the due diligence to other people that can help you if you ever want to take one of those down. But it's just a matter of what difficulty you're looking into and what heart are you choosing.
So do you avoid that then and you leave it to people like the guy you just mentioned?
We do. Yeah, we do. We avoid this completely. Even wastewater treatment, we bought a portfolio where there were 2 parks and one park was city sewer, but the other was wastewater treatment plant. We almost backed out because of it, because it's not ideal. It's the second worst sewer scenario after the lagoon, but we still did it and we had some headaches with it, but it's fine. It's just you have to be careful when you underwrite it. You have to have higher capital reserves because repairs can be pricey on these things. But we stay away from the lagoons. We do mainly. And even going forward, we do, of course, do city sewer because that's the best, really. We still have to check things there as well. It's not just like, oh yeah, city sewer, check the box and move on. You still got to check things and scope the lines and stuff. But septic we touch. I mean, in the south, in where we operate in the southeast, there's a lot of septic tanks, and we have a lot of experience with them and a lot of contracts we work with. So we know what to do there and what to look for. So yeah, we mainly stay away from the lagoons though. We don't want to touch these things.
What else do you avoid and you won't touch?
Very small population cities and towns, if that makes sense. So actually, like we bought that portfolio I just mentioned that we bought where one was with the wastewater treatment and city sewer. That was in a smaller town. And if it's close to like a bigger city, like in proximity, actually that's where manufactured housing communities can be very powerful because you could be close to a city, let's say that has 50,000, 100,000 people, but let's say 20 minutes outside of town, you're in a little town that has 3,000 people. If you just look at that one town, you might say, oh, that's too small. That doesn't make any sense. But a lot of people would love to live cheaper and commute to the city. So that can be very powerful in those tertiary markets. But that one park we bought, that portfolio I just mentioned, that was in a 3,000 or 3,500 people town. But the next bigger town was an hour and a half away. And that was a mistake that we learned from. We're still meeting the business plan, but it takes a lot of bandwidth to do so because the leasing is extremely slow. We underwrote slow, but not that slow, if that makes sense. So the occupancy it's going up, but it's extremely slow. Just marketing to people in other cities you have 4 or 5 requests a day, and this one you have 1 a week. It's just a lot slower. So we stay away from any small markets that are not close to a bigger, at least secondary market. That's why we stay away from. Also, at this point, we have over 1,100 units. So we also stay away from smaller purchases. We're not buying like a 15 unit, 20 unit anymore. So anything that has to be like 50, 60 plus in stronger markets, or if it's with stronger, I mean like higher lot rent markets, might be like a Florida market where the lot rents are double from compared to the Carolinas. And then Carolinas will be like 100, 150 plus units. And the next deal we were doing right now is 283 units. So we need some scale to really cover the overhead that we are building, right? As the company gets bigger, you kind of moving the goalpost up, and you need that higher income to, support the team, and buying more income to, feed the machine and feed the beast, so to speak.
What does your team look like from a management perspective? Do you have someone living on site, or, how do you handle working with the residents and making sure that everything is taken care of properly?
So we always have community managers on site. So we have a back office. That's our property management company that we own. So my partner and I founded that property management company, which serves all our assets that we have. And then the community manager is in direct contact with the back office at all times. And the back office mans the phones, like for leasing, maintenance, and also just like in general collections. And always we have somebody that just calls people just to make sure that people pay their rent on time and stuff, especially for newer assets. Once it's stabilized, it's not a big deal, but we acquire a lot of things right now and at a time. So we need a lot of collection efforts there. If there's emergencies, they always get it escalated to the community managers right away. But from a hierarchy perspective, we basically have, if you look at the property, there's a community manager on site. There's an overarching asset manager that's on the team, which is one of our main partners that manages the assets. And then the back office, our property management company, supports the asset manager and the community manager with this individual maintenance efforts and also leasing, etc., so to speak. And then the asset manager reports to us, myself, and my partner, Tim, as well. So we have weekly meetings where we go through all the numbers, like the collection rates, delinquencies, occupancy, income of the week so far with the collections, of course. And also look at lead to application conversion for leasing, application to lease conversion, and so forth, move-ins and stuff like that. So all those metrics we look at, and we actually get those reports daily from our back office. Like in the first thing in the morning, end of the day, we see a full dashboard of everything. So it's very tightly knit, and it kind of was created from my background when I was in manufacturing as an executive there. So automotive is very fast paced, a lot of data and efficiency. Everything has to be streamlined. And I kind of brought that out into the business, which helps a lot to get a lot of transparency. So yeah, that's how we have it structured. It works really well for us, I must say.
Tell our listeners how they can find out more about you, get a hold of you, and anything else you'd like to plug.
If you'd like to learn more about us, you can go on our website, WCGinvestments.com. You can kind of go in and just also download our free ebook where we just talk about why we love mobile home parks, go into more detail than I just did of why we love them so much. What's so good about them. You can also book a call there that goes to either myself, to my partner Vinny, and Tim. So it's kind of like a round robin calendar thing where you can just go in and just book a call with us. If you want to reach out to me directly, I'm very active on the major social media platforms on, Facebook, LinkedIn, Instagram. You can reach out to me there directly with my name, Matthias Gruenwald. And I'm happy to help out if you're interested in investing with us, or just want to learn how we did it, how we run things. Always love to help people to get started in real estate, and especially with manufactured housing communities. So yeah, looking forward to getting some feedback from the audience and see how I can provide even more value, even after this podcast.
How are you using AI in your business?
A lot of things. So actually the collections that I just mentioned, we're going to roll out an automated collections bot as well that makes phone calls, leaves voicemails, sends text messages based on what we have in our rent manager, property management system. So AI is very active there.
Is that something you created yourself, or is it part of your PMS?
No, it's like a software that we are integrating into rent manager. So we didn't create that software, but there's services out there already that do that stuff for property management companies, and we are implementing that. So that's really powerful. So that's AI is the future. Obviously, it's so powerful. And as we're growing so much, it actually compresses the need of hiring a lot more people. We can just keep the same core team, add a person or so or two, but don't have to hire 5 people at a time if we take on like a 280 unit like we do next, because the AI never sleeps, right? 24/7, it's always available, never sick, and can make all these phone calls for us. So that's super powerful. So yeah, looking really forward to getting more AI implemented as well to drive the efficiency on our team going forward.
Well, Matthias, thanks for coming on the show today to talk about manufactured homes, mobile home park investing. You've given us some good strategies for what to look for in order to add value, and kind of what to avoid to not make those mistakes that might be costly. So it's been a real pleasure talking with you. Thanks so much.
Thanks for having me, Brian. I appreciate it.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.